When your furnace dies or your fridge floods the floor, a home warranty sounds like rescue. But the first clue is always the fine print. These companies sell certainty, yet their contracts are built on uncertainty. The business depends on systemic flaws that ordinary customers only discover after filing a claim. Every claim enters a machine designed for friction. The longer the delay, the more customers give up, and the hidden ledger quietly favors the company. The exclusions are not side notes. They are the business model. Pre-existing conditions, maintenance gaps, and vague warranty language create built-in denial pathways. At the start, the product feels like protection. But institutionally, the contract shifts risk back onto the homeowner while keeping premiums flowing upward. This is hidden economics in plain sight. Many customers pay more in fees than they ever receive in repairs, and that spread becomes pure margin. The repair itself is often not the goal. The real game is controlling authorization, price caps, and approved vendors, all through institutional design. Executives do not need every claim denied. They only need enough friction, enough delays, and enough partial approvals to preserve the margin. Delay is a weapon. Time pressure pushes people to pay out of pocket, making the warranty seem less like a promise and more like a bureaucratic trap. Where does the money go? Into administration, marketing, vendor pressure, and often investor returns. The repair fund is only one line in a larger ledger. Door-to-door promises rarely match contract reality. Sales teams are rewarded for volume, not for future claim satisfaction, which distorts the entire system. The first sale is emotional. The later claim is procedural. That gap is where the company collects profit and the customer discovers the hidden rules. Many contracts steer disputes into arbitration or narrow complaint channels. That reduces legal exposure and strengthens regulatory capture through procedural complexity. A simple repair becomes a debate over maintenance history, installation standards, and whether the problem qualifies under a shifting definition of coverage. The secret profit margin often lives in vendor pricing. Contractors may be paid low rates while customers are charged high fees, preserving spread at both ends. Claim reviews can look formal, but the incentives are simple. Denial codes, low ceilings, and narrow approvals protect balance sheets from expensive surprises. Even when a claim is approved, the payout may be capped far below market repair cost. That gap quietly transfers risk back to households. The structure scales beautifully for the company because most customers will not file often. That is the hidden math behind the entire industry. The business does not need to beat every customer. It only needs the average claim to cost less than the average premium, after friction and exclusions. Over time, policies evolve by accretion. Each amendment tightens language, narrows coverage, and deepens the institutional design that protects the insurer. For older homeowners, the emotional cost is severe. A repair delay can become unsafe living conditions, while the company treats urgency as a billing problem. Technicians know the system too. Low reimbursement rates discourage quality contractors, leaving the company with cheaper vendors and customers with weaker service. A large share of the budget may go to marketing and acquisition, not repairs. The product is sold like protection, but financed like a churn engine. When oversight is weak, companies exploit regulatory gaps state by state. That patchwork invites regulatory capture and makes enforcement slow, uneven, and expensive. Most customers cannot fight a contract war. The cost of legal action exceeds the disputed repair, which gives the company quiet leverage. Look at the hidden ledger, not the brochure. Premiums in, denied claims out, service caps enforced, and the surplus remains with the operator. This industry survives on trust borrowed from the idea of insurance. But home warranties are often lighter on regulation and heavier on exclusions. Approved vendor networks create another layer of control. By routing jobs inward, the company manages cost, quality, and the pace of every repair. Customers think they are buying certainty. Instead, they are often buying access to a claims process that behaves like a gate, not a guarantee. The profit story is simple. If premiums stay stable while payouts shrink through denials and caps, margins expand without needing real innovation. The sharpest clauses are often buried in plain language: sole discretion, normal wear, improper maintenance, and excluded components. Those words do the real work. Partial approvals create a psychological trap. The company can claim success while the homeowner still pays most of the bill, and still feels insured. Pending claims are not just paperwork. They are capital in motion, money held back while the customer waits, confused, tired, and increasingly powerless. Put the pieces together and the structure becomes visible. Marketing buys trust, contracts hide risk, delays reduce payouts, and the surplus flows upward. The scandal is not one bad company. It is a business model built to look protective while exploiting asymmetry, confusion, and institutional design. When the promise breaks, the clause survives. That is the system, paid to promise, engineered to refuse, and protected by policy language. Subscribe for more.